Welcome to this episode of Insurable Risk. My name's Mark O'Reilly, and today we're talking with Nathan Ray, who heads up the new business and marketing initiatives for Austbrokers Countrywide. Based on your experience, what are the top 5 issues that you regularly see throughout the review process?
Number one issue is the named insured. People often don't have the actual correct entity listed on their insurance policy. The entity should be related to that's what is the triggering clause of the policy, and that should reflect all businesses that rely on that insurance policy.
So more particularly, self-managed super funds, trading names, that type of structure is what you're referring to?
Absolutely. The number 2 issue is, at the end of the day, is the business description. The actual occupation of the business is almost the most important component of the cover, because that will determine the level of premium the insurer applies, and also determine the quality of the limits and the type of policy that the insurer will want to provide. Number 3 is the business interruption section. Often you will find that this area hasn't been reviewed in the last few years, but it should be reviewed on an annual basis, because the business interruption section directly reflects upon the turnover of the business and the trading and profits and the changes within the business, and that should be reviewed only because the business changes every year, so should the BI. It should be reviewed regularly.
So let's just talk about business interruption. What is business interruption?
Business interruption, at the end of the day, will replace the company's profits and their income at the time of a claim. If you have a fire, your turnover goes from $1 million down to 0 overnight. The intention is the insurance policy will replace that loss in income throughout the next 12 months or 18 months, whilst your business isn't in that full trading capacity.
Number 3.
Number 3 would have to be gaps within the existing program. The gaps within the existing program, by meaning, is the actual insured amount. How much you've got cover for over the different areas. Over the different areas might be extra costs of working. You might need a higher limit than what you've already got, because you would rely heavily upon outsourcing your manufacturing if your business wasn't operating. Another area might be that you might have a high theft risk. We would review that relating back to point number 2, your business description.
So on a large-scale property program, we might have 15 to 20 individual limits. Do you look at individual limits?
Absolutely, because at the end of the day, the intention of the policy is it's going to respond to one claim, but it also might respond to multiple claims depending on the location of the policy. So the adequacy does that sum insured apply across three claims, or one large claim, or is it only going to apply to one small claim? An example, a property owner, he might have 3 or 4 properties. 2 of those properties are next door to each other. Therefore, we would have to allow a limit sufficient enough to cover two incidences of a claim, or essentially one large claim, not individual claims on 4 individual properties.
Number 4 issue.
Number 4 issue would have to be management liability. In our industry, we're seeing a dramatic uplift in the operations within a business and claims arising from that.
And the number 5 issue?
Would have to be the level of the excess. The clients these days, they tend to think of having a very low excess and they don't think anything about it. But realistically, their opportunity or their risk of actually having a claim might be very low. So therefore, in order to obtain a premium advantage, we might recommend a higher excess or a level of self-insurance at the end of the day. And that then suits their specific needs and suits their risk. Therefore, it is a tailored point.